what we saw back with the bank crisis in early 2023 is the distinction between banks that haven't managed risk wealth. So they didn't allow for the effect of rising rates. And those are the ones who got squeezed or were simply not managing risk well at all, like Credit Suisse. What's happened since then is the banks, the larger, better capitalized banks, have strengthened their positions by taking more access to cheap funding on the deposit side and a flight to quality. Regulators have been on top of these risks for many years, forcing recapitalizations. The area that's probably more vulnerable are some of the local banks in the US that are lending to lower quality real estate portfolios to their loan book.
Tell me about the consumer then, which tallies on, I think, quite nicely from the conversation you and Karen were talking about banks as well. I hold my hands up. I don't know whether this very strong labour market we're seeing in the United States is going to maintain its strength as well. But at the same time, people look fully employed, give or take, and yet at the same time, we are beginning to see problems with delinquencies, which you mentioned there. We're seeing higher costs for families, for corporates, for sovereigns as well. Why should the consumer remain robust, even if there are more of them keeping jobs than previously people expected with the Fed tightening cycle?
Well, certainly our expectations is that the economy does weaken and inflationary pressures ease as people do have to spend more on debt, and at the same time there would be some slowdown in the jobs market which is going to flow through. So I think one way to view the current environment, again, is to step back and look at the last few years. And you had extreme tightness in labour markets in the boom in 2021. You had a series of supply constraints globally. We're seeing the unwind of those things. And although it's a bit harder to see in the US data, you can see it everywhere else, the easing of labour market conditions. So it seems on balance to us, but that is a slow motion, change in the labour market, which is going to both...
Not a slow motion car crash, which you just stopped yourself from saying those two words, didn't you?
So I think it will depend upon how the authorities respond to the evolving conditions as to where we end up. But our view is that it's possible for the economy in the US to have a slowdown without necessarily invoking a deep recession, and also for inflationary pressures to ease. So to that extent, I think that's our central case.
Okay.
In this environment, you've got to acknowledge that there's a variety of factors that can cause things to move off your central case, but that is our central case.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.